Hello and welcome into the KE Report. Shad and Corey here as your host, and today we're getting an update from Nick Hodge. Nick is the co-owner of Digest Publishing and editor of Foundational Profits and Hodge Family Office. Nick, it's always great to get you on the KE Report about once a month. Here's our cadence and dive into the macro, dive into the micro. On the macro side, we're kind of in an interesting place here. A lot of tension, a lot of uncertainty about the economy. Are we slowing down? Is the GDP now estimates that we're going to be in the negative GDP territory, showing that we're really getting closer to more of a stagflationary environment? And the general markets have been taking it on the chin, Nick. Some big red days in U.S. equities, in the tech stocks, the tech leadership. What do you make of the weird stew of ingredients that we have pulling together here as we kick off March?
Well, March has come in like a lion, which is the axiom that we know, in like a lion, out like a lamb. And nothing really new, except that we continue to be confused and uncertain, which is a word that came out of your mouth and is a word that I've seen in headlines increasingly over the past month or month and a half as the tariff shenanigans have rolled out and been rolled back and been canceled and delayed and challenged in court and increased and decreased and reversed. Hopefully you got all that because that's how the market feels. That's why the VIX spiked to 29. You had a S&P that was, hitting multiple records in 2024 and seemingly nothing could slow it down. We were talking last month when we convened here at the KE report that, one of the things that was going to be good for the resource and precious metal space was a rolling over of the tech sector. And you've seen that in a very big way over the past couple of weeks. The S&P is down. I think it corrected actually, right around exactly 10% correction on the S&P, and the Nasdaq has taken it even harder than that, down some 13% since its recent highs in February. And there's lots of things going on. At the end of the day, I'm a macro growth and inflation guy, and so you hit the nail on the head. The uncertainty that the tariffs and the Trump economic regime has brought on has caused everybody's models to contract. And the Atlanta Fed is saying that GDP is going to fall off a cliff and could in fact be negative for the current quarter. Even though I'm a pessimist in the market and I tend to lean bearish, I don't think the US is in for a true recession. What I think, and what I was trying to explain to my buddy on the walleye boat the other day while we were fishing, is that the market thinks about not necessarily absolutes, but how things are changing. And so this morning, before we started recording, you saw that CPI is starting to go down. We had a 3% print last month. We're at 2.8%. This month, you have things that are softening, right? Egg prices will likely start to come down. Coffee and chocolate have come down, which were recently at highs. Even shelter has softened a bit and will likely continue to. So the market doesn't like that disinflation. It doesn't like when prices are going down, and it certainly doesn't like that when it's commensurate with a slowdown in the rate of change of economic growth, which is what the second thing that the market is concerned about in terms of GDP. In my macro letter last month, I went through the GDP calculation and all the inputs that go into it. And, government spending and employment is a big part of that GDP number. And here's the U word again, with all this uncertainty, we don't really quite know how the GDP is going to flow through here in the coming months. And so what all the market knows is that inflation is going down for the time being and growth will likely go down. And that's led to the selling that we've seen in the broader market in recent weeks here. We've got a Fed meeting coming up. You likely won't get a cut. But until we get some certainty, the opposite of uncertainty from the Fed, there could be significant more volatility ahead. I'm not calling for a recession. I think the growth itself, the underlying growth, that underpins the U.S. economy will be okay, even if you get to a 0.5% growth, for example, in the first quarter. It's not negative. It's just a slowing down, and I think that will smooth out in the second half of the year. That doesn't mean that equities can't go lower, and so I'm watching the VIX very closely. It's not wanted to go above 30, which is important, although it did, get all the way up well past 20. It's been well below 20 for a long time, most of the past year. Went to 30 right away. The fact that it doesn't want to go above 30 means to me that This market got the correction it was looking for. Trees don't grow to the sky. You need a healthy correction in a bull market. And so I'm not deploying capital hand over fist into the S&P. Like most of the S&P sectors have been down over the past couple of days. But what I am looking to do is deploy capital into S&P sectors that I view as bullish. Happy to talk about some of those, but the ones that are typically do well in when the market is looking for defense, and also ones that typically do well when rates are going down as they have been. So I went back into utilities last week. That's worked out okay so far, and I'm really eyeing up REITs or the housing and real estate space in terms of S&P. And then on the precious metal space, gold has done really well for reasons that I've talked to you guys about. The trend is now down for rates and the dollar, and gold hit all-time record highs while those things were in its face. And I was telling you last month in February that as they rolled over, there would be further tailwinds for gold, and we've seen that as gold flashed down to 28.34 or something like that, but went right back up to 2900. So that's the backdrop. And one more thing before we drill down is, I can't keep track of all the tariffs. Clearly, the market can't. But what I would say is one takeaway is that it's putting a spotlight on, some of the themes that me and my partner Gerardo have been talking about for going on a decade here. And that's the need for the Western Hemisphere to secure its resources and metal supply chains away from the East. And I'm no fan of tariffs, and I'm no fan of volatility, and I'm certainly no fan of crashes and drawdowns. But I am a fan of getting the mainstream's eyes on this problem that I've been talking about for 10 years. And certainly I'm keen on the solution to those problems because those are very profitable for me.
Well, Nick, you're absolutely right in the fact that we are seeing a shift more to these defensive sectors outside of the dollar, though. I find that interesting. But the VIX spiking up, it does make sense when you consider that outside of July of last year, these markets just kept trending higher and didn't even see a 10% correction where we're already there with the S&P. But the dollar is the one thing in this whole defensive trade that I find interesting, especially this month. The dollar's already down 4%, and we're only on day 12 of this month. The last time we saw a big correction in the dollar was November 2022. That was a 5% down month, and that was also right around the peak of the dollar, around that 114 level. Look, I think all eyes are on that 100 level on that dollar index, where right now we're around that 102, 103 level. Why aren't we seeing money go into the dollar if we are seeing a broad defensive move by investors?
Because the Republicans aren't serious about cutting the debt, and they never really were. I was presenting on this back in November when the Doge thing first came out, and I love the idea of it as a small government guy and a libertarian-minded guy, but the reality is quite different. The budget projections are still for rampant deficits and debts. We know what Trump did the last time he was in office, and he's projected to continue to run up the debts this time. So you're getting great headlines, and I'm not even really sure what's going on social media anymore because Musk was so ferocious that I had to mute him a couple of weeks ago. But they're generating a lot of buzz. I see the things about USAID and the cutting of staff and the Department of Education, et cetera, and on down the line. But then, where the rubber meets the road is much different. We've already seen the U.S. Supreme Court say, no, you can't just cancel $2 billion in USAID payments, et cetera. And so the mud in the swamp is stickier than anyone wants to admit, and it's really hard to do what Trump says he wants to do. And I'm not even really sure what he wants to do at the end of the day, given his track record from 2016 to 2020. So to answer your question directly, the reason the dollar is going back down is because we're going to get rate cuts later this year, back to sort of an easing policy, and you might even get some direct QE as the Treasury Department and the Fed slow down their sort of rolling off of bonds from the balance sheet. The Scott Bessent has been talking about this and has said he's sort of keen to continue the policies of Janet Yellen, and so that's what I see. I see inflation going back up after a period of cool down here, as I was saying earlier, down to 2.8%. You could likely see that fall, and then in the next month or two, and then go back up in the second half of the year. And so I think you get more easing. The market is increasingly pricing in rate cuts, definitely pricing in one by June and then as many as three by the second half of the year. And so I think the market is knowing that the Republican administration and the Republican Congress isn't going to be able to surmount the debt issue that plagues the United States.
Well, Nick, you mentioned the defensive posture people have, and yeah, they're not doing the dollar, but they are getting into sectors like utilities that you mentioned in REITs. We've also seen the financial sector do a little better than people were expected. But then obviously gold is still that safe haven appeal, and even silver has been peppy lately, up above 33 again. We've actually seen an interesting phenomenon the last couple weeks where the precious metals sector overall is diverging from the general equities. Some people have come on our show, Nick, and said that that's what we need to see to really see a true secular bull market in this precious metals complex in real terms, meaning that it's gaining on the general equities. Do you see this as a positive sign for the precious metal sector, the way things have been playing out?
I mean, that's just one of the positive signs. So that's not an indicator I look at per se, though I did see my friend Brian London tweeting the chart of the, gold to S&P ratio, which does seem to be breaking out, which is what you're alluding to. But more importantly is I think the first thing you said is that, you put up a chart of gold versus the S&P. There's a clear divergence over the past couple of months. The other thing which I mentioned in addition to sort of a tech rollover the last time we spoke is the earnings reports and the upcoming conference season, which has now passed. So you've had Newmont and Barrick and Agnico all report earnings, and you had some pretty good reports come out of there. I'm pretty sure all those companies beat guidance. I think across the board, AISC, all-in sustaining costs were coming down a little bit at Newmont and Barrick. I think there were shareholder friendly announcements. Barrick announced a dividend. There's ongoing buybacks coming out of this free cash flow from selling gold at 2,700 bucks. And so I think that gets the attention of generalists. And that was the call when we spoke in early February, is that after this earnings season, excuse my language, but Newmont had shit the bed in the previous quarter, right? Costs were up, and the stock had been screaming into the Q3 print. That this was I won't even say a surprise. It was just pleasant. I mean, it was good news, which is rare, I would say, as a 15-year veteran of the commodity and resource space. But these stocks are starting to have healthy balance sheets. The assets have been divested, which I believe Shad mentioned the last time we talked, and they're actually looking like good investments for a generalist investor. And that's one of the reasons that I think you've seen that separation between not just gold, but gold equities from the rest of the pack over the past couple of weeks. The other thing is that I understand that mining is a sector and it's part of the S&P, but it doesn't get sort of its own designation, right? It's not talked about and it's not identified the same way we look at staples and discretionary and IT and communications, et cetera. There's no metals complex. It's buried and divvied up between the industrial sector and the materials sector, which are two of the least talked about sectors of the S&P. And so when the sell button gets hit by the algorithms that are selling broad-based baskets of equities and mainstream components of the S&P, the resource sector sometimes gets a pass in that respect. And so multiple dynamics going on, but what you say is true, and will likely be get more of the same. Good performance, outperforming the S&P, should continue to attract eyeballs and dollars that want to be treated well.
Yeah, these last couple of weeks have been very interesting to see the gold stocks perform well while the market continues to move lower. But on that topic of these majors, their revenue numbers are very good. Even their earnings are very good, again, driven by the gold price. But you dive into the larger miners like Barrick, like Newmont, those aren't even close to all-time highs. They're not even at 52-week highs. The growth really in some of the shares has been in these producers that have growth in terms of production. How are you analyzing some of the top tier mining companies here, Nick, where again, the big ones, they aren't providing those kind of gains that the ones a little bit lower down the food chain are?
I don't spend a lot of time analyzing larger companies. I've told you guys that. So let me talk about it in terms of recent M&A. So I think that these sort of mid-tier companies that have been doing well, and frankly, even some that haven't been doing well, are desperate to get bigger. And they can do that just by merging, right? Even if there's not a really good jurisdictional or operational reason to merge, we're seeing companies want to get bigger just for the sake of getting bigger. And I would point to the most recent acquisition or merger in the space of Equinox and Calibre or Calibre, right? These companies were not struggling on their own. Calibre had been a wonderfully performing stock and was likely going to continue going. And you can see that investors didn't really want them to merge with Equinox, which has been delayed in getting its greenstone mine up and running and has had some cost increases, as we all have across the board with inflation, et cetera. But you saw shareholders not want to reward them for combining just for the sake of combining. And so I think that you're right. It is a stock pickers market. Investors would have preferred those two companies to stay separate and let Calibre, operate in Nicaragua, et cetera, and let their cash continue falling to the bottom line. However, I think we're going to continue to see mergers for the sake of mergers. And so for me, these mid tiers have sort of performed better. You mentioned that Newmont wasn't near all-time highs. It's a sort of a $40, $45 stock and was an $80 stock. But these smaller stocks that I've mentioned to you before, the Alamoses of the world, the Wesdomes of the world, these companies are at 52-week highs. And so for me, I think the majors have catching up to do to sort of some of these mid tiers that have had stronger runs over the past year or two, if that makes any sense.
Yeah, Nick, I think the mid tiers have been leading the charge because they are the ones that can actually show some growth where it's very hard for the big companies to grow. That's why they've been divesting instead of adding assets. And to your point, I think we'll see more and more mid tiers team up to form bigger companies like the Caliber and Equinox deal. It'd be good to see more M&A in the sector just in general because it starts combining cash, freeing up cash, rotating cash. It's good for the sector. As far as silver, do you have any thoughts on some of those companies? We did see some M&A deals there at the end of last year with Gatos and Silvercrest being scooped up. Not as many companies to pick from, but silver is that speculative side of the precious metals complex. Any interest in the silver stocks?
I do. And I think we did this last month when we talked. You mentioned acquisitions there in sort of central Mexico and in and around Chihuahua. And I've been talking about a company to you called Kingsman Resources that's about to drill there. Silver continues to be bullish. Last time we spoke, it was, I think, around $33. It pulled back a little bit in the past month and then has perked back up. It continues to be bullish. It is worthy of buying on the dips. Yeah, I'm not always a silver bull as I've told you in the past as well. But silver for me is bullish. We own silver equities in the monthly letter, Foundational Profits, and is worth adding on pullbacks, not just the silver miners, but the silver in general, either through some sort of paper ETF or a physical trust like Sprott offers. I think that silver is schizophrenic or bipolar, and it goes back and forth between wanting to be an industrial metal and wanting to be a precious metal. And I think for the time being, it's got on its precious metals hat and is going to trade with gold as we continue to have all this, back to the uncertainty and the volatility. I believe gold and silver are going to be looked to as safe havens, and so bullish on silver as I've been in the past couple of years.
Well, silver stocks are really starting to play some catch up too. Hopefully that continues for all the silver bugs out there. The one thing I do worry about is if silver plays too much catch up, sometimes that is a sign of a cooling off period, a short-term top, but still could be a lot of ways, a lot of room to run for the silver stocks. What about copper too, Nick? It seems like copper is closing in on $5. Quite frankly, it sounds like a lot of tariff news on this, and some countries just talking more favorably to the critical minerals again. What's driving this copper move in your eyes?
Yeah, copper's getting bullish. In fact, I've been out of the macro copper trade for a while, and this week I'm putting together the March issue of that macro letter I just mentioned, and I'm looking to get back into copper. There's a lot of things driving it. China has come on strong here in the past month or so, is talking about stimulus getting back to 5% growth. I think that's one thing. Trump has initiated this Section 232 review for copper as a critical metal in the United States. The United States reliance on imports has grown in the past couple of years, getting much more from South America, Chile, et cetera. I think that, as I said earlier in this discussion, just the talk of metals tariffs on been primarily steel and aluminum, but in his talk to Congress last week, he let slip that he wanted to put tariffs on copper as well. And I think that's just lighting a fire under investors who might not have considered copper or looked at copper before. So generalist investors coming in. I think there's been a rise in the domestic copper price here on the COMEX relative to the prices in London, just because the world is rushing to get metal into the United States before any potential tariffs take hold. And then you have traditional, tailwinds to the metal space that we've already discussed in terms of a falling dollar and bond yield. So all those things have taken copper prices up. Copper was wedging down. As recently as February, it was wedging down. I mean, it was after reaching $5 sort of last year and in the spring, summer of 2024. It wedged all the way down to almost $4. And in fact, to start the year, January 2025, it was $4 and it decided to break out. It's added 85, 90 cents in the past month and has broken out of that wedge. So that's one of the main takeaways for your readers. The wedge down has been broken. Copper is now breaking out. If it were to consolidate here, it would likely do so higher at the sort of 455 to 465 level. And that's a really good price. So copper in and of itself, it has been a good investment. There's not a lot of ways to buy copper. There's fewer physical trusts, right? Like there is for gold and silver and even some of the PGMs. They do exist, of course. I think COPR or CPER, excuse me if I get the ticker wrong, is an instrument that tracks just the price of copper. What hasn't done as well, and this is what's got me sort of interested in looking at the space, is that the equities, despite the 25% bump or 20% bump in the price of copper in the past 2 months, the equities haven't kept pace, right? And again, I don't do a lot of analysis of large miners like BHP, Rio, Southern Copper, Tech, et cetera. But I do look at the charts and I do spend a lot of time analyzing ETFs. And when I look at the charts of BHP and Freeport, they're at 52-week lows. And in some cases, they have really healthy yields. And then going a little bit further down the chain, I'm starting to see improved metrics, right? Improved earnings, and the equities still aren't getting love. And I don't have an answer for you there other than, markets have been weak over the past couple of weeks and maybe they're just getting overlooked. These copper stocks aren't catching a bid. If you pull back the chart to a 5 or 10-year time frame, you'll see there was some weakness back there to the left that I hope doesn't want to backfill on the charts. That's the one thing that's giving me pause. But at the end of the day, I'm pretty sure I'm going to go back into copper this month, and I'm going to do it either by buying Freeport or I'm going to do it by buying a copper ETF. And I've talked to you about these before. What's interesting is that as I've been doing my research, my copper research here this month, is some of these mainstream ETFs, and this is reflective of what I was just saying, like CopX, for example, the global copper ETF, it hasn't had significant institutional inflows. I think it was only up like 1.8% in the past year or for all of 2024. And so that echoes what I was just saying about copper equities not getting love. And at the same time, thinking about things from multiple durations and stances, that long-term fundamental case is there, the same as it is for other commodities like uranium, in that, we know that there has to be an upcycle for copper. We know that the mines are getting old, et cetera, et cetera. And maybe one more macro thing is pointing back to these tariffs. There's a lot of potential mines in the U.S. that are sitting there that could be developed if we got our heads on straight in terms of the permitting process and regime in the United States. So all those things could materialize into bullish sentiment for copper miners and copper developers, particularly those with assets in the United States, and then from there, assets in countries that haven't yet been targeted by Trump. Who knows what country will be targeted next? But all that to say that I'm pretty keen to get into copper equities, given what the underlying commodity price is doing, and given the weakness that copper equities have seen for the past year or so.
Well, Nick, just in listening to you review that, I was thinking about that initiative that Trump did put in place where he was looking at where is the copper coming from and was exploring, do they want to put tariffs on it? And the research came back that 90% of the copper that comes into the US comes from Chile, Canada, and Peru. And those are
Sure.
some big copper countries for sure. But it also has people speculating that, to your point you just made, maybe US domestic copper plays are the ones that'll finally get a light shine on them as far as the permitting issue and the moving these things forward at such a glacial pace that there's no way to bring on new supply in a fast way in the copper space. So maybe getting some support from government in states like Alaska or Arizona or Utah or even Idaho now starting to see some interest in copper. Do you think there's going to be a premium on U.S. copper stocks, U.S. copper equities, if we start seeing some of those kind of red tape reduced?
That's what I'm saying. Yeah, and that's sort of been my thesis for a decade or more, right? And that's what I was saying earlier in this talk, the reliance by the West on the East for its foodstuffs, for its rare earths, for its copper, for its nickel. That westward flow is going to be changing, and in fact is changing. And that's one of the main tenets of my career and one of the main theses on which I invest, right? Is where are this next generation of resources going to come from? And this is going to sound cliche, but to fund and to make real the energy transition, right? Which we've been hearing about for, well, gosh, I started in the investment industry in 2007, and I was writing about clean tech back then. That was 20 years ago, right? So it's tough to see the forest for the trees sometimes. And we're in clickbait headline land and social media land and headline a minute land. But the backdrop here is that, whether or not we have an orange-haired president and whether or not tariffs were the flavor of the week or the month or the year, the underlying fact is that the U.S. needs to secure its sources and future supply of all these metals, not just copper. And so, yes, with an exclamation point, I believe that copper developers in the West, specifically in the US, are going to fetch a premium. I'm looking at a list right here. I won't go down the whole thing, but we just had Gunnison Copper, come on Resource Stock Digest. That's in the American Southwest, a company I've made money from before and been a shareholder of and sold Arizona Sonoran Copper. And so, yeah, what you say is true, Shed. Any clearing up of this red tape or any like rectifying in investors' mind this thesis that is, I see pretty darn clear is, I just been waiting for more and more people to understand it. And yeah, it takes time, 5, 10, 15 years in some cases, but I've done well over that time, and I think that trend continues. And that's again the important takeaway for me, and I think your listeners is that in 4 years, Trump's going to be gone, and tariffs will be what they will be. But these mines, development assets in the U.S. will likely still be being developed and still be in permitting. And so these opportunities span and last beyond 4-year terms. And so that's it. I don't want to get into word salad, but yes, 100%. I think that Western copper companies, I think there'll even be some clearing up of the air between Canada and Mexico, et cetera. So I even include those in jurisdictions I look at and think that they will fetch a premium. Yeah.
So, Nick, you're sounding quite bullish here on these major commodity sectors like gold, copper, even down to silver. Does that mean you're taking aggressive positions now? Are you pretty much fully invested, or are you still waiting for, who knows, other questions to be answered for your portfolio?
So I got to break it in two because I do things two different ways. On the macro side, where I would buy like a Freeport or a copper ETF, I've still got some cash. I got about a third cash in what I call my long-term capital portfolio. I print that every month, by the way, every position I own and what percentage of my portfolio it is. And as of this month, I'm still in about 31, 32% cash, some of which will likely go into a copper ETF, like I was just laying out there. On the smaller end of the spectrum, I'm getting a bit more fully invested. So the last time we spoke in early February, I told you I had written my first check into a private placement in a long time, my first check since October. Since then, I've written three more checks, right? And I won't go through them all, but yeah, some of those are large porphyry projects in Canada, right? Like I helped finance a company called Quartz Mountain Resources most recently. That comes out of the Hunter Dickinson group, which has had really good success with that A-Mark hole that everybody was talking about at VRIC in January. Well, Quartz Mountain's got two gold, copper, porphyry discoveries in BC, two separate projects, and they'll be drilling them both this year. We wrote a pretty good sized check into that, me and my group. And I also write a letter just for private placement investors called Private Placement Intel that you say I sound pretty bullish. Well, I meant to bring this up earlier and I forgot. I should have made a note. They are bullish, like that group of investors, because, when I put out a deal, the company lets me know, X amount of dollars or subscribers came in from your list. And these past couple of deals I put out, including the Quartz Mountain, are some of the highest totals that I've seen in some time. And so it's not just, Nick Hodge that's opened up his checkbook in the past month or so, but, these high net worth subscribers of mine are keen to write checks as well. And so am I fully invested on the small side of the spectrum? I'm getting pretty darn close. Like I could probably write another check or two, but if I want to start deploying more capital, then I got to scroll back down my list and see what's going to get replaced, i.e., I'm going to have to sell something to come up with capital unless I want to take it from somewhere else, which I typically don't like to do. So yeah, Corey, what you say is right. I'm feeling pretty bullish. Got cash on the macro side, but I've been buying these tiny companies via private placement as I do. For the most that I've been doing, I'm looking at my list of private placements. Like I think I've written more checks already in 2025 than I wrote in all of 2024, for example.
It's an interesting sentiment reading and temperature taker there, not just of the checks you're writing, Nick, but as you mentioned, your group of investors and how they're excited to get into some of these copper plays. Let's talk about one last sector in the commodity space that people are not excited to write checks for right now and has been in the hurt locker, and that is uranium stocks. Man, uranium stocks, Nick, have gotten beat up for the last 9 months. I think a lot of them peaked last May. It's almost been a year since we've seen any real green shoots. There was one or two little reprieves for a month or two in there, but other than that, it's been a downward sucking sound in the uranium equities and in the uranium price. But there's still a weird divergence between all the macro fundamentals just from all the reactors that are out there in the field currently and the restarts and the life extensions and the uranium supply. So at one point, something's got to break. What do you think of the weird divergence between positive fundamentals but negative sentiment and negative price action in the uranium space?
It's been brutal. Hurt locker's a great word for it. I mentioned disinflation earlier, and I mentioned that some prices for commodities have been coming down. It's been very bifurcated in terms of which commodities catch the inflation flu and when. So it was the soft commodities, the agricultural commodities that had been very strong in the past 3 to 6 months. Again, coffee in the headlines, chocolate in the headlines, eggs in the headlines, etc. Corn has been very strong, and I think during that period, you mentioned last May as sort of a peak. Some of the metals that go into the CRB commodity index that are inputs to inflation have softened up, right? Nickel's been soft, lithium's been soft. Some of these other prices in the metals complex outside of precious metals have been soft. Platinum's got a bit of a bid, but palladium remains soft, et cetera. So in that context, uranium was overbought and it got caught up in this disinflation is just an easy word to lump these commodities into. And so it had to pull back in that sense. And then the underlying commodity price for me now is overdone. A couple of months ago, I was talking about a cup and handle chart where the handle should have completed itself around the $70 mark for spot uranium prices I'm talking about. And that would have happened sort of in the December timeframes, 3 or 4 months ago now, right? What we've seen that since then is uranium prices continue to come down. At last check, I believe the spot price was at $63. If I look on a chart, which I'm doing right now, you can see that there was a sort of a spike to $63, $62 in April of 2022. That could become a place where the uranium spot price chart catches its fall. If it doesn't do so there, then it'll definitely do so by the 50 to $55 level, and then will be completely oversold. So, could there be marginal downside ahead for uranium? The answer is yes. Is there much more upside ahead than downside at this point in the uranium space? I also think the answer to that question is yes. And I'll flip over to the URA chart for a second, and we can talk about just uranium equities as a broad basket. So, Corey, earlier you mentioned last July in terms of a big month for markets, and that was because of as you'll recall, the Japanese yen carry trade unwind was in the headlines for a week or so there. When that was happening last summer, last July, early August, we also got a crash in the uranium equities. The URA last summer in July, it was a $31 fund, a $31 stock. And by the first week of August, it was $22 as it completely got sold off in that yen carry trade unwind. It then rose to $27 by later in the summer and flashed back down to that $22 level in September before recovering back to higher than it was throughout the balance of 2024. You'll recall as we headed into the fall last year is when we got all the announcements from the AI and the tech companies that were still popular then, right? The Microsoft announcements at 3 Mile Island, the Amazon announcements for the small modular reactors, etc. And then, but what we've seen in sort of late December when we had sort of the DeepSeek scare, right? You guys will recall this. I know it's a headline a minute, and some of these are tough to remember, but that sort of pricked the bubble, the AI bubble, and inadvertently pricked the bull market in uranium as well. And then we just got to follow through with the selling over the past couple of weeks, which we've all witnessed, broad-based selling, right? Which, to my point here, has taken the URA ETF all the way back down to exactly 22, where it has now bounced off of, again, the same level it bounced off of last July when volatility spiked. So from an equity standpoint, I think we're pretty cheap here. So again, barring the end of the world, the VIX going above 30 to 40 or even 50, barring that, yeah, I think you bounce from here in the uranium equity space. And hopefully by now you guys have heard my broken record screech enough that you'll know what I say next. It's that I watch, again, back to the domestic producers, right? Same sort of thesis as copper. The U.S. is going to have to procure its future supply of uranium. That's been my thesis for a decade. And I've made good money in it. And in watching these stocks for a decade or, God, more at this point, Fukushima was 2011, I think. So it's more than a decade. But you get comfortable with their levels and their charts. And so what I see from those big board listed American producers and developers, the UECs, the Encores, the Energy Fuels, is that they're oversold, right? And so I've begun buying Energy Fuels. I was already invested in Denison and had a standing limit order down around $1.50 US. Sometimes I just look at my inbox and I get trade alerts. Your trade has been filled. Well, I got one of those alerts this week for Denison. I don't even remember when I said it, right? So it hit the level that to me is the level that you deploy capital in the uranium space. And I believe that's where we're at now. And that's what I'm doing.
All right, Nick. Well, I think we'll wrap it up there for today, but sounds like bullish on gold, bullish on copper, even a little bullish on silver, but taking the contrarian bet and looking at good value to be buying the uranium equities here where the charts have pulled back to. A lot going on in the commodity space, a lot going on in the general markets. a lot going on in the macro sphere as well. So it's a lot to keep tabs on, but we really appreciate you coming on here and unpacking your thoughts with us about once a month here. And if people want to get more thoughts from Nick and his partner Gerardo, definitely click on the link below this interview. It takes you over to Digest Publishing, and you can see all the different publications that they write for subscribers. Some of them are very macro focused. Some of them are very focused in resource stocks. They even get into, like Nick mentioned, private placements, cryptocurrencies. There's all kinds of different things on the offer over at Digest Publishing. So I hope people listening check that out. Nick, always great having you on the show. And as always, looking forward to our next conversation.
I appreciate the invite. Thank you, guys.